All right, looks like we're live. Welcome everybody to Live Valuation. I'm Midas and today we're going to be taking a look at ticker RGR, Sturm Ruger. We've covered this one before on the channel a bit, and we've also kind of covered other companies related to it, so it should be pretty interesting. Kind of very intentionally covering companies in a grouping of it. I was already pretty interested in Smith & Wesson, so I'm just paying attention to this one partially because I wanted to see how valuation stacks up on this one next to it. Make your move. Cat cannot decide where he wants to sit. It's like, please just decide one way or the other. Anyway, I'm also taking a look at other companies in the sort of the same grouping as we kind of talked about, the retailers and sporting companies that sell firearms, such as Dick's Sporting Goods, Sportsman's Warehouse, and Big Five. We've covered all those, and I'm looking to probably be updating those valuations as well in the near future. I've been kind of making a list of future valuations, a little bit more precise than the kind of like haphazard list that we've had for a while. Actually kind of putting them on schedule with each other based on when certain 10Ks come out, for some of the summer 10Ks, because some of them kind of come out a little bit, as well as when certain valuations in our list are getting to a certain age that I kind of want to have them either updated or dropped from the list. That's kind of how I like to operate the watch list. Is like once valuations are about a year old, it's like, well, make a choice, either value it again to keep it updated or drop it from the list because it's outdated information. So yeah, we're kind of putting together a little bit of a list today. Obviously we're covering Ruger, but then our next stream, which I'm planning it for Friday, we're planning to probably be doing Dick's Sporting Goods, and then the next one after that, which I think is probably on the Tuesday after that, then we're probably going to be taking a look at Big Five at that one. And I think the one after that, I'm probably going to be switching over to perhaps Foot Locker at long last. People have kind of been wanting me to do Foot Locker a little bit, but I think I'm mostly going to be taking a look at that one partially because of my holding in Hibbett. But anyway, digressing from the kind of schedule of companies that we're going to be taking a look at, thinking some factors, some other things. Although actually first, before I even get into that, in the chat, the pinned comment is the link to the Discord, as well as in the description is the Discord. Please, if you're interested, join our Discord group. We have all sorts of discussions about the daily news, various portfolios, company analysis, hints from various major investors and other videos and things like that, as well as just discussing ideas back and forth with each other. Really great community we're trying to grow, as well as if you're watching, you haven't already liked it, it would be really appreciated if you could like the stream. If you're watching, you're not already subscribed, if you could subscribe, that would also be appreciated. The more likes we get, the more viewers we get, more subscribers we get. More subscribers we get, the better our community and our discussions become. So that's always great. Taking a look at some economic news that we're expecting this week, it should be pretty interesting. Obviously, we had a pretty rough morning, which is to be expected considering the CPI report that we had on Friday, but it's not really going to end there. Tomorrow we're getting the PPI report, which is basically just going to help bring in a more of a forward thinking about what maybe the next month or two of CPI reports could look like. It's only part of the picture. It's just the producer index parts of the equation. We have to factor in wages and all that stuff, but it's a good forward looking measure that I like to think about. As well as the day after that, we're getting retail sales and import export prices, business inventories, housing market, and the FOMC release, because the Fed is going to be having their meeting this week. So we should be getting that announcement on the 15th. So all sorts of stuff happening this week. Not to mention this event called Triple Witching is happening on the 17th, on Friday. I had actually never heard that term before until I was looking it up. Apparently, the simultaneous expiration of options, stock index futures, and stock index options all on the same day, which is pretty interesting. And obviously, just that could go either direction depending on the dynamics of what's happening in the market. I could imagine all sorts of weird upward and downward movements in various stocks related to that. So that should be very interesting to see how that does or does not affect the overall market. But yeah, so just on net this week, all sorts of very interesting economic data to be paying attention to. So one other interesting thing I kind of wanted to cover before we actually hopped into the valuation of Ruger specifically was kind of just taking a look at like how interest rates affect valuations and the equity risk premium and stuff like that. So we talked about a little bit of that on some of the specific stocks in our last stream. Like we were talking about Nerdy in particular. There's questions about like why the valuation had collapsed so much, why my own estimation of its valuation had collapsed so much. And I said the interest rates had a lot to do with it, but also just changes to the expectations about growth. But I figured I would discuss that a little bit further with my estimations of like how to value the market index, the S&P 5 index itself, which I do have a valuation of it essentially sort of right here, my sort of estimation of it. And with that, I brought up also my spreadsheet that I use for estimating the equity risk premium, which looks very, very similar to the valuation thing. It's kind of the same process, just you're making differences on it. One is basically saying for the equity risk premium, you're basically saying if the index is fair value today, if the market is right. If the market is right and the earnings that is projected by the analyst is right, then what is the implied returns of the index? Based off the interest rate that's coming in at 3.3%, I have a different spreadsheet for that right here. Then it gets an implied 8.75 or so percent per year for the next 5 years in the index as it's priced currently, which gets an implied equity risk premium of 5.45% or so. So that's what's implied in the index based off of the pricing is today. And then you can change what's based off of what's implied to come up with what you think. So if I think that earnings this year are going to be half as much as that estimation, and the next year is going to be 75% as much, but if we take the interest rates as a given and the equity risk premiums as a given, then the base estimation of the evaluation should be 2,800 or so, or 2,900 for the S&P. It's currently about 3738. And then you can make estimations based off that. That's a base year effect. So a bear case, I might say, is 25% lower than that, which would be 2,100. And a bull case, I might say, is 33% higher than that, which would be 3,800, which is not too far off where it currently is. Which is, by the way, why I chose that percentage, is that the 33% brings it to about where it is. And then the 2,100 brings it down to a lower level, which I'll explain in a second why I chose that. That number isn't just haphazard. Then I have percentage weights to assign to each of those, and that gets me my risk adjusted valuation of the market, which I say is about 2,800 right now. And where did I get this 2,100 as my bear case? Why do I think the S&P in a bear case could go to the 2,100 when it's currently at 3,800? That's the interesting thing I wanted to bring up, which is how interest rates can affect valuation. Let's assume that the interest rate, the current 10-year treasury, is currently at 3.3%. Before today, it was at 3%. So let's just say that because I made these estimations with 3. Let's assume that what the Fed says they're going to do is accurate, and they're going to bring the interest rate up to their federal funds rate up to like basically around 3 to 5%, depending on how long the inflationary period lasts over the next 5 years. So let's assume that they actually do that, and that means that the 10-year treasury would have to be at least 1 or 2% higher than that. So I'm going to say 6%. Actually, we'll say 6.5% for that. No, actually, no, we'll go back and just say 6%. I don't want to overestimate for that. Then let's go back to the equity risk premium. That's going to move into here, and then we have to readjust what the equity risk premium would be saying based off of those estimations. So let's say 13.5%, because with our risk-free rate of 6%, we want a risk premium that's roughly similar to that, which was kind of what we were doing before. Maybe a little bit less than that, so maybe 13.5 is too much. We can switch it down to perhaps 12.5. Actually, no, I think that's why I'm going to just go with 6.5, because it makes it easier to do these estimations. 13, 6.5, 6.5. Then we also have to shift the earnings to basically the estimations I was saying before, 50% down for the next year, which is about 115, and then forward 185, which was 75%. So that brings the valuation to say that the market is still roughly saying that the index is equal today, based off of a discount rate of 13% and a risk-free rate of 6.5%. So you can see if you change the interest rates and you change the earnings together, you can still make the equity risk premium equal what it's supposed to, which is saying that the market is accurate as it's priced today. But what does that mean about my personal valuation for the market? Now, we already shifted the earnings, so we can bring these back up to 100% since we already shifted the earnings and the other aspects of it. And where does that bring the base valuation of the market? To 2,200, with risk adjusting for a bear case down to 1,600, and then a bull case to 29 to 30 or so 100. With risk adjusting it brings it to 2,150, which is about where my worst case scenario was. So basically, that's what I'm trying to say is like if the Fed actually raises interest rates where they say they're going to bring it to, and earnings are affected the way that they would be affected under a situation where earnings would grow that way, then you could actually see a situation where the S&P 500 drops to 2,100 versus the 3,700 it's already at right now, which would be about 43% down from where it currently is, which is pretty crazy to think about considering it's already fallen a decent bit. So let me just put all these numbers back, because like I said, this is just kind of thinking about the future, guessing about what the Fed may or may not do. That's not necessarily to say that it will go all the way that far. I think there's a good chance the Fed will keep pushing and pushing, and then eventually we'll be forced to pause and maybe even reverse course at some point, based off of just the pain to the economy alone. Because I don't think that they would allow the S&P to go to 2,100 based off of that sort of information. Of course, they may not be able to prevent it. It just might take a lot longer. It may not happen because of interest rates. It might happen because of the pain of inflation and how the inflation affects margins, because they might just choose to let inflation roll through instead, is basically what happens. Okay, so everything come back down to where it was. Yeah, so you can see bear case around 2170 or so. The bull case 38, which is a little bit higher than where it currently is. And then the base case at 2829, I get 2,800 or so, which is 25% down. So my risk adjusted estimation of the S&P is still 25% down. That's assuming 65% chance of the base case, a 10% chance of the bull case, and a 25% chance of the bear case. So yeah, I'm pretty pessimistic about the index. I do this pretty regularly. I try to keep an estimation for the index all the time, because this is one of the measures I use to try to determine how much cash I should be holding on hand. It's like, how overvalued do I actually think the index is? I don't just hold this number precisely, but I hold a number based off of that. So anyway, a large diversion into kind of thinking about the index and a little bit about macro, because like I said, I kind of wanted to explain like just how precarious of a situation our market really is in, given all of the interest rate changes that have been planned, as well as the inflation that's kind of on the other side of the hammer if one were to choose not to do those things in the first place. But we can move on to the actual valuation for today. Sturm Ruger. As I said, we've already covered the company before, so we're not necessarily going to do super in-depth analysis of like everything and making looking at their presentations per se. Everybody's pretty familiar with what Ruger does, generally speaking, selling lots of handguns and a decent amount of rifles as well. I did actually do most of my estimations already for the company, so we can kind of basically just kind of show exactly what I'm thinking about it in general projections. And I didn't build up a model for the revenues specifically. We're mostly just kind of thinking pretty top-down level, keeping relatively similar revenue expectations is what I'm thinking about for Smith & Wesson. Either way, we're putting it in the segments of retail, special lines, and recreation, about half and half each, which gets me to an unlevered weighted beta of 1.01. Sales capital ratio expectation of 1.86, and the net margin expectation of around 4% or so. They operate pretty much entirely in the United States, so we can use the U.S. equity risk premium as our base, which brings it, after updating it for the current point, up to a 5.41 for where it currently stands. And they basically have no debt, just a small amount of lease liabilities, 0.15%. So that brings their levered beta to 1.01, bringing their cost of equity to 8.82. Which is not too bad, all considered. Like not holding the debt makes a pretty significant difference for their valuation. That means that they don't have quite the same level of risk they might otherwise have, because obviously with their unlevered beta already over 1, that means that they held like, I don't know, 30 to 50% debt. That would have a pretty significant levering effect on them. But anyway, with that, as I already said, they have a pretty small amount of debt. It's only about 2 million or so. It's on a weighted maturity of about 12 years and 2.3% interest rate. So no real necessary thinking about rolling it over. And obviously it's such an insignificant level that it really wouldn't make a difference. In fact, it might even benefit their company to take on a little bit more debt, but that's neither here nor there. So taking a look at their financial history, we can see that from 2012 they went from 492 million dollars in revenue to 731 million dollars in revenue, with their gross margins staying in kind of this lower 30s range as a general average, though it does move up and downward depending on the year. We have some higher 20s, 24 being a low point here in 2019, but also moving up into some higher levels, higher 30s in some of the earlier years, 2012, 2013, and also the most recent year of 38% in 2021. Looking over the average over the entire time frame, it comes to an average of 32%. So either way, that gets us a baseline idea of just how much the gross margins could fall from where they currently are to get back to sort of a base level, which would be about a 6% drop from where they currently are. And I mean, just thinking about how that would affect their margin, which is at 21%. If they just drop 6% from there, that would bring the margins back down to 15%, which would be roughly in line with where the margin was in 2020. And in 2020, the gross margins weren't too far off from that longer term average as well. So 14% might be a reasonable way to think about like where the margins would be if it's just based off of the loss of the gross margin and not based off of any of the other operating costs as well. If we were to take other operating costs into it as well, then obviously it can drop a little bit further than 15%, which we'll get into that with our margin assumptions. We might even adjust that a little bit further because that's something I hadn't fully thought about. The way the gross margins were differing from the net margins. Taking a look at the net margins, which was what I was mostly thinking about when I was doing this a little bit ahead of time, you can see that prior to the jump up in sales in 2020, the average margin they had was about 11%, which was more of what I was generally thinking about. If we add in the most recent years and think about the entire history, it's more like 12 to 13%. Which 12 to 13% might be closer to where we would see if they lost all the gross margin gain they had and had a little bit of operating cost loss. Instead of dropping down to 15%, 13 to 14% might be more in line with what we would think. If we were to think about the difference, say, in the most recent 5 years, which was 13% versus the 5 years prior to the jump up in excess sales, that becomes 10.5% versus 13%. So it's about 2.5% difference that you could perhaps think about. So 2.5% plus the 6% on the gross margin switch, that'd be 8.5%. Subtract 8.5% from 21.3, and you get what, about 12-13% or so, depending on how you want to count it. So I don't know, that's perhaps a good way to think about where the margins could go over the long run. I think I was thinking more about 11% when I was doing my estimations before, so maybe we'll give it a little bit of a boost up based off of that. I think that's pretty reasonable logic to think about. Taking a look at their cash flows, you can see over the last 5 years, they had an average of $80 million per year to pay out to shareholders after netting out debt expenses, comparing that to the $103 million per year that they were having in the 5 years prior to that. In the 5 years prior to that, they weren't paying out anything to their shareholders at all. They were paying out a decent amount in these 5 years, coming out to an average of $59 million per year. So still significantly under the amount that they could have been paying out, which is always good to see. Definitely not overpaying the shareholders. And it's mostly in the form of dividends, which is typically less likely, it seems like, in more recent years to be having that problem. It's typically share buybacks where people are getting a little bit ahead of themselves. Well, I guess I shouldn't say that so strongly. It kind of depends on the sector, but either way, looking at the way that their cash flows have generated themselves into returns, you can look at the returns on invested capital, very, very strong over the last 3 years. I mean, at an average of 26 to 27%. It might make sense to take a look at more of a longer term average for this, which if you include some of the earlier years, it actually shoots up pretty significantly. Maybe we'll think about more of a midterm average, 26-27%, which is pretty similar to what we was saying for the 3-year average. So that's probably a good way to think about it. 26 to 27%, still very, very strong. The returns in equity are not really that much different than that because obviously, like I said, they don't really have much debt. So you're not really going to see a huge leveraging effect. They're going to be pretty similar. As we were saying, they have been generating pretty good cash flow and not overpaying their shareholders, so they have a decent amount of cash on their balance sheet. It is lower in 2021 than it was at the end of 2012. Let's see if maybe that's just a fluke of that particular year. You can see that the average for the first 5 years of our history is about 50 million in cash and equivalents per year versus 35 million. So no, there has been a little bit of a decrease in their cash balance overall, but you can also see that they're holding marketable securities in the more recent years. So if you were to actually take those things into account, then now you can see that that's actually probably where the majority of their cash is being held, which is pretty interesting to see that they started holding so much marketable securities in the more recent years when really interest rates have been kind of low. But whatever, either way, it's effectively pretty close to cash, and even if you were to give it a liquidity discount, it still more than overcomes the difference from the first 5 years. Taking a look at the accounts receivables, it does look like those have also grown from 54 is more recent years. Actually, never mind. There was some heavier ones in there that I was looking at kind of the end years. 60 million was the average for the first 5 years versus 54. So technically, they've actually dropped in accounts receivables, which is always nice to see. I thought it was actually slightly higher than that, so that's always good. Inventories as well, that has dropped barely, but it has dropped from 35 million to 34 million, which it is at 43 to 44 million currently. So it is a little bit above the average in the current year, which is always a little bit of a concern. We've definitely been trying to watch where the inventory has been going for a lot of the companies we've been valuing. However, it is a gun company, and gun inventories at least don't go bad and hold their value relatively well. So that's a relatively strong type of inventory to be holding compared to plenty of other ones, I guess I would say. Overall, looking down just at the way that their assets have performed over time, going from 174, 175 million, or an average over the 5-year period of 275 million, to 442 million, or an average of 351 million. So pretty strong, significant growth in the assets, while their liabilities have stayed basically flat. You can see it's actually slightly downward from that first year, as per averages over the time frame. It has decreased over the 5-year period, but then basically just grown back upward over the last couple years. So yeah, really strong balance sheet. Really strong balance sheet. Basically all assets. There's not much here in the way of liabilities at all. They can pay off all of their liabilities with just some of their marketable securities. You know, it's a pretty damn strong balance sheet. It doesn't really get more strong than that. If you're trying to pick a company to buy in the middle of recessionary worries, well then, I mean, Sturm Ruger's looking pretty good. Obviously comes with all sorts of other concerns, but that's just part of investing. It's like, if you're going to get free bonuses in one area, you're typically going to get something in another area. So one thing that's interesting to see is the change in the sales to capital ratio over the entire time frame. However, you can see the sales to capital ratio for the first 5 years of our historic period was averaging 4.5 or so, versus the second half period, it was closer to 2. So it's very interesting to see this very consistent downtrend in the sales to capital ratio. Now, sales to capital ratios aren't usually at this super high level unless you're a very service-based business, or a very relatively low cost manufacturing business where like the capital levels are extremely cheap or something like that. So it is a little bit interesting to see that they had this high sales to capital ratio, and that part was probably the fluke. And the way that it's moving down towards this relatively high but still more reasonable level in the more recent last 3 years is probably more representative of the longer term history. So we might aim towards something like that in our future projections moving forward. So actually getting into that, we can actually just slide right over and we'll just go ahead and start straight with that. You can see the last 3 years on average was 1.81 as we have right here. And I am essentially assuming that we're going to have somewhat of a consistent trend towards that over the time frame, with the average of all the outcomes that we have being 1.79. We're actually going to probably tip that down a little bit because I see that this was left a little bit higher than I was expecting, where I thought I had left it last night. We're going to tip this a little bit downward, which brings the average to 1.65. So it's a little bit lower than there is in the last 3 years, but maybe not as large of a downward increase as we saw over the previous 5 years prior to that, as well as the expected brings it to 1.46. And then we'll move up to the, I'll move down to the debt to equity ratio and kind of cover that. I have it at a range of 0 to 5% with 2% as the analyst level. It's like I said, it's basically no significant levels right now, but I think it's pretty reasonable to assume that they might take on a little bit more debt just if they roll over their lease liabilities at most, but that doesn't really have a huge significant effect on the value. But anyway, so moving past that part, we can go up to the revenues, which this is the thing where people's opinions might differ, and it comes down to like what you think about gun manufacturing, as well as the politics surrounding it, and like what do you think is most likely to occur over the next few years or so. I'm the type of person that doesn't really think that there's actually going to be that much change as far as like what types of guns can be manufactured. They might do a few more restrictions in place for like making it harder for people to actually purchase them, and like the process you have to go through to purchase a firearm and who can purchase a firearm. But I don't think there's going to be as many restrictions on the actual types of weapons as some people might be pessimistically assuming. That's just my personal opinion, but we will kind of build in some scenarios assuming both sets of things. So the average revenues over the first 5 year of our period was 588 million or so, versus the second half it was 545 or 546 or so million. So if I'm using the 3 year average as a base to kind of give us an example of what it would look like if we had a pretty large shock to the revenues in the near future, which gets me an expected, based off of all the scenarios, 575 million for the next forward year, which gets us a drop of 21% or so. I'm assuming a negative 10% downward from that point on in the worst case scenario, and a 10% growth in the best case scenario from that point on in the best case scenario, with the midpoint between the median and the more optimistic end for the analyst end. And that gets us an expected revenue of 608 million in the 5-year forward period, which is 16 to 17% lower, pretty significantly lower than it currently is. So I'm assuming that it is going to go down about 21%, and then they're going to grow up a little bit more from there, but it's not a very significant amount of growth. In fact, it's basically baking in pretty significant loss chances. So in our worst case scenario, we're basically assuming that like they lose about half their sales. But this is our huge gun regulation scenario. This is the scenario where like a huge amount of the guns that they make are no longer viable weapons to be manufactured, and they have to stop manufacturing them, and they have to limit the types of things that they can sell. And then our best case scenario assumes that they actually move on to record revenues within 5 years. It's not a huge growth in record revenues, but it is a growth to record revenues. As well as our analyst expectation numbers, we assume that they go back to higher revenues than they had in the most in 2020, but not in the most recent year. So still pretty significant revenues. And if you take the effect of the rebasing and the CAGRs that we have thereafter, it actually comes out to essentially the worst case scenario has an expected CAGR of negative 14% per year, and the best case scenario is a positive 4 to 5%. So yeah, very, very pessimistically baking in the numbers as far as the revenue expectations go. We will shift our expectations a little bit based off of the probabilities, which you can see here. I've already tilted it a little bit more towards the optimistic end, and I will actually tilt it a little bit more because I don't think that some of those more pessimistic outcomes are actually necessarily that super likely. I'm putting 40% of the weight in the 0% movement from the rebasing effect. So I'm assuming 570 million, 40% of the outcomes. With 616 coming out to be the expected value after shifting to 25% for the 5% after rebasing, which would give me 728. So I have 25% chance assuming that they basically achieve the same revenues they had in the most recent year, 40% chance assuming that they go back to the revenues they had in 2020, and then 15% chance assuming some pretty pessimistic scenarios where regulation cuts the revenues near in half. With like only a 5% chance of really, really optimistic things, and then another 15% kind of somewhere in the middle between those. So yeah, that's kind of the way that we're thinking about the revenues. We'll shift down to the margins, which, like I said, I was thinking about some things a little bit differently in terms of margins, although it looks not too far off from what I was expecting. I was saying 12 to 13% was where I was going to maybe put it. Because like I was looking at the average, not including 2020, 21, and it's 11.27%. And then we kind of re-added up some differences between the gross margins as well as the expected averages and net incomes. And I was saying like 12 to 13% might be a better midpoint. We're keeping pretty low margins as for our worst case scenario, because we kind of have to assume that based off of the worst case scenario items we have. But yeah, we might shift up the average a little bit higher to kind of get it more towards that, like I said, 12 to 13% level. Let's see. I'm not sure I necessarily want to shift this higher than 18%. But maybe I'll shift the probability a little bit more. Let's see. Yeah. We'll shift the probability for it a little bit more. And where does that leave it? That leaves it at 12.3 or so. Yeah, okay, I'm okay with that. I think that's a good enough shift in the margin. Okay, so then that gets us an implied return on invested capital of 18%, versus, like I said, the most recent 5 years has been 26 to 27%. So we are assuming a pretty significant drop in the returns on invested capital, which comes with the drop in revenues, the collapsing of margins, as well as a continued downward decline in the sales capital ratio. So, we're being pretty fairly, I think, pessimistic on all of the fundamentals, and we're still coming up with a pretty good valuation. That's pretty awesome. You can take a look at the interest coverage ratios are all pretty well. I kind of covered the default risks already before the stream, and it doesn't really shift too much because they basically have no debt. So that doesn't really need to be adjusted. That's not really something that we're going to think about, considering they just have so little of debt. But yeah, so that's pretty much all of the assumptions that goes into this. I don't think there's too much more that needs to go into it. Let me think. Am I forgetting any other major thing before I do the summary? Yeah, okay, I guess that's basically about it. So that basically sums up for RGR, Sturm Ruger. U.S. Treasury currently selling for 3.3%, 3.345. Equity risk premium as we currently have it is 5.42%, and that gets me to a discount rate after adjusting for company specific idiosyncratic risks of 8.82%. They currently have a 4% dividend yield, so pretty decent dividend yield. 5 years ago, they had sales of $664 million versus 731 million in the most recent year, which came to a sales growth of 1 to 2% per year for the last 5 years or so. Sales to capital ratio for the last 3 years that we used as that average of 1.81 versus the industrial expectation of 1.86, so relatively close to that. Hey, Nugget, looks good, but I already hold a bit of SWI. I don't want to overexpose myself to gun makers. Yeah, I feel you. Like I said it at the start of the stream, part of the reason I was updating this valuation was because of my interest in WBI. I think the SWBI is the better buy still, and it looks like it's still the better buy, and it looks like it comes up just like a better qualitative company in general. But they're both very good quality companies. But I partially just wanted to have the comparison, as well as I did comparisons, and we'll be updating those in the coming weeks for the retailers, the gun retailers as well. So I'm kind of basically doing a gun grouping a little bit right now. Which I swear I was interested in doing that before recent political happenings. That was already on my agenda. That just kind of threw my way. Anyway, returns on invested capital 26 to 27%, as we said, over the last 5-year average. Debt to equity ratio of basically about 0%, no real amounts of debt, which basically comes to a default risk of 0 for them. Profit margins in the last several years on average have been 15%, with a profit of the most recent year of 156 million. Yeah, exactly. There's been other people talking about them and definitely been bringing it to my attention. And like I said, they've been in my watch list for a while, so I've been seeing SWBI moving up and up in my watch list, and so I've just been wondering about that. And RGR had been lagging it, but it looks like it's jumped a little bit in my watch list today. But like I said, it still looks like SWBI is a little bit better. But anyway, currently selling for $64.91. The probability distribution that we're using for this is pretty heavily tilted towards the more optimistic models, which is partially just a factor of how I'm weighing in some pretty pessimistic outcomes for our worst case scenarios, but I'm not actually believing that there's that high of a chance of them happening. So everything on the probability is pretty heavily tilted to one end of the screen. With that, we have a worst case scenario of $337 million in revenues in the 5-year forward period, which comes to a decline of 14% or so per year for 5 years. So very, very significant decline. That's our like high regulation outcome, essentially. Although the one above that is pretty close to just as devastating. And in the best case scenario, we have $918 million in sales, which would come to 4 to 5% sales growth per year for the next 5 years. On an expected basis, we see 624 million, which comes to negative 3% per year. So overall, yeah, we're seeing a decline in revenues, but just based off of the fact that they've had a very bubblicious last couple years, and that it'll probably decline and then regrow, and then throw in some recessionary concerns in there. And this is kind of the balance where we end up at. Sales capital ratio assumptions, I see a distribution of 1 to 2.25. On an expected basis, I see 1.48. We get to returns on invested capital on an expected basis of 18.21. And debt to equity ratio, we're kind of assuming that they will take on a little bit more debt, if nothing else, just to roll over the current lease liabilities that they have. But it would probably be good if they could actually take on like 5 to 10% debt, so to even outweigh my expectations here. But either way, expected value of about 2% or so. And with that, we get no real decline our default risk as a result. We have a profit margin distribution of, in a worst case scenario, about 3% in our very, very pessimistic recessionary and regulatory concern outcomes, basically assuming that like a lot of their high margin products disappear as like half of their items get taken off of the sellable list, and all the way up to 18% in our more optimistic range. On expected basis, we see about 12.29%. So definitely seeing a decline in the profit margins, but overall nothing too pessimistic, but we do have to weigh in some of those outcomes. That gets us to profit expectations, a worst case scenario of $10 million, so pretty bad, to a best case scenario of about 165 million, which is not too much higher than currently is, but last recent year again was a kind of an exceptional year, so that's pretty good anyway. On an expected basis, we see 77 million, which is, not amazing, but there would probably be a pretty significant decline in share count during the period as well. That just is part of how they return part of their the returns to shareholders. On an expected basis for the share price using the discount rate that we have, we come out to 72.81 as the present value, which is 12% higher than the current share price. 5-year forward value targets, unadjusted for the dividends that they'd be paying out during the period, goes from anywhere from 28.73 in the worst case scenario to possibly 211.18 in the best case scenario. I see 111.10 as the expected value, which compared to the current share price gets us an implied return of 11.35%, which is not too bad. Definitely pretty solid returns, risk-adjusted returns. Nothing too exceptional though. Trying to aim for something at least 50% higher than that, if not close to double that when trying to open positions myself. But if somebody already holds Ruger out there, it's definitely far from a sell, at least. So that is that. So that's the Ruger valuation. Not too much that I'm going to be covering in today. I did the stream early, partially for a reason, which is that I'm going out of town today. I'm actually heading out to Vegas for the week. So that's part of the reason it's kind of on a different day at a different time a little bit, but I still wanted to make sure I got some valuations in. As I said at the start of the stream, and I kind of was talking about a little bit before there, we do have plans pretty much laid in as far as what our next few valuations are going to be. On Friday, when I get back from Vegas, I'm planning to do my next stream. I'm going to be updating my Dick's Sporting Goods valuation, which we have in here somewhere. So that is the next one I plan to do, and then after that I'm probably going to be doing Big Five. So kind of in the same vein, like I said, is the gun manufacturers and the gun retailers, and then I know that SWBI is going to be releasing their 10K within like a month or so as well, and so then we're going to be hitting them again as well. So yeah, we're basically trying to like get that grouping all together. Don't gamble unless you count cards. Oh yeah, don't worry. I'll be hitting the blackjack tables, but it won't really be my money as much. It's kind of a late birthday gift to me from my dad, so it's actually probably gonna be mostly my dad's money we're gambling. Not that makes too big of a difference. I mean, he's probably gonna be retiring in my house, so it's sort of kind of all our money in a way. But whatever. We're keeping it responsible. Don't worry. We don't look at blackjack as a way to make money. We look at it as entertainment while we drink, which I think is the correct way to think about it. It's like you're paying money through the chips to get the drinks, and you're basically just hoping that you get drunk enough that you're satisfied with the amount of money that you spent. But we're also trying to hit like shows and stuff to not be at the tables all the time. We're gonna probably hit Blue Man Group, maybe hit a gun range, probably do like a day trip to Hoover Dam, the usual Vegas stuff. But yeah, should be fun. So I'll catch you all, like I said, probably again on Friday. For those of you that are in the Discord group, I will probably still be posting things throughout the week in the Discord, because there'll be plenty of downtime, and I'm on my phone constantly anyway, and I can't not think about markets. But as I also was pointing out at the start of the stream, be wary of all the stuff going on this week. It's definitely going to be a pretty crazy setup of economic events kind of moving throughout the week. That's going to have pretty major factors. That FOMC meeting is starting tomorrow, as well as the PPI index comes out tomorrow. Then we get the retail sales and import-export prices. Import-export prices is sort of like another inflationary gauge if you think about it. Business inventories as well, housing market index, and then we get the FOMC release with the Fed chair. I'll definitely be watching that no matter what's going on. It's only at 2:30 p.m., so I probably won't be doing anything major. And then the triple witching event, as I was talking about, the expiration of all the options and futures all on the same day, could lead to some strange price movements. It could have some individual stocks that have some very, very weird movements that go contrary to the market on that day. Who knows? But either way, it should be interesting. So everyone, watch out for your portfolios. Try to keep your head cool, and try to keep some cash on the sideline, because probably going lower. So I'll catch you all next time.